You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Think back to 1 year ago. What was the world like 1 year ago? Well, it turns out that 1 year ago, just about 1 year ago, was the one of the biggest declines in the stock market in the United States, actually globally, in many, many years. There was like a 30-some-odd% decline in the value of stocks around the planet. It looked like the end of the world was coming. We were under attack from a foreign bug. We were pandemic sized. We were scared to death. The economy was going to collapse. Everybody rushed out of the market, and the bottom was hit in March of 2020. Did you get out? If so, did you get back in? I'm Don McDonald. That's Tom Cock. We're talking real money. So, Tom, did you get out?
Well, I didn't get out. And here's the other thing about that decline you just mentioned. It wasn't just the amount, it was how quickly. In 20-odd days, it went down, as you mentioned, over 30%. So there were a lot of people, some of our clients included, who wanted to get out of equities, out of stocks, because, as you said, and they told us this, well, we've never faced anything like this before.
Right. It's
this
new.
is a whole new thing. This is the world may never recover.
It's a new market paradigm.
It's new market paradigm. So we've seen the numbers. A lot of people sold stocks and moved into bonds. Most of them moved into cash because they just didn't know what was going to happen.
Nobody wanted to go into
next.
bonds either because everybody was of the opinion that not only was the economy going to fall apart, but then interest rates were going to go up.
Exactly. This was the double-headed monster that was going to eat up your portfolio and smile and laugh after it finished it off. So yeah, this was a very and we're being silly, but it was a very difficult time emotionally. I can remember talking to a lot of you about the reasons not to sell, not to get out of the market, and yet you did. So let's talk a little bit more about that because it's a fascinating thing.
To you if you got it. Well, you probably know if you got out.
A lot of people already know, but I'll give you more specifics and I want to give Andrew Hooley, a certified financial planner at Vestry, full credit for running these numbers for us. So this is April 1st, 2020 through the 23rd of March, 2021. Okay. So let's just assume that, that you owned, and boy, I hope you did, U.S. small cap value.
Oh, nobody owned small cap value.
Not very many.
Nobody wanted to be in it because it was bad.
It was horrible. It had been down, down, down. And by the way, not very many people own it today still because you kind of think you do when you own one fund. You own a little tiny bit of it. You don't own enough. And here's the reason you need to own a lot is because there are periods of time where it pays a large premium. And guess what? The last year, that's one of those times. U.S. small cap value in the form of AVUV, the Avantis U.S. small cap fund, up 126.61. Now, that might not sound like a big deal, but let me give you the actual numbers. Had you invested $10,000 that day, guess what? You had $22,661 at the end of that year.
Wow. Wait.
That's
wait.
fairly
You more than doubled your money?
Yeah, in a year. Wow. Again, and I remember we had the guy on the show a couple weeks ago. He said, I'm going to run out and buy that. No, you just need to have this all the time, always in your portfolio. Okay, but let's assume, and I think it's a good assumption, that you didn't have all of your money in U.S. small cap value. We're not recommending that.
I didn't.
Okay, thank you. Me either. I didn't have that kind of lack of diversification, but I did have a global portfolio of big companies and small companies, growth, value, U.S., international, all those places around the globe.
Yeah.
That $10,000 April 1st, no fooling, grew by 64%. Your 10,000 at the end of this period.
Oh, wait, I can do this math. 16,400.
Yeah, there you go.
Thank you.
So that's still a pretty good return. But then let's go one more step, because a lot of you are not 100% in equities. 100% in equities takes some real steel when the market goes down, right? Because you could see your portfolio decline by 50%. And we know very few of you can take that sort of hammering and go on. So you had a global stock portfolio, but you had 40% of the money in bonds. And you said, it's down 20 odd percent in a very short period of time. But markets have come back and economies have come back and things have worked out. So you had the 10,000 in there. And guess what? You made 38%, 37.78. So your 10,000 grew to $13,778. Now, we're not saying this to make you feel bad. No.
If you want to feel bad, I'll tell you how much you would have made if you had it all in Bitcoin.
There you go. Or maybe Tesla since then. But here's the thing. We do have some things we want you to learn. Number one is, and this, people will say this until the cows come home, and I'm still waiting here for them to come home. They will. I'm not a market timer, because market timing has a horrible reputation, like it's evil, or there's some person in a closet that's doing, but nobody else is paying attention. But so many people do it. They sell out, they buy back in, because we see the numbers all the time, what you do. That's why people end up making far less than the stock markets. So don't time markets. This is a very good lesson on how it doesn't work. There's many people, by the way, in this first quarter that have said, now for sure we're headed down. Not yet, hasn't headed down yet. So don't time markets. Here's part two of this. Don, you have talked about this ad nauseum.
I do make people sick.
I can't spell it, but I can say.
Yeah,
I can
it
spell
just
it,
basically means I make people sick.
Exactly. Always have your money exposed to a wide variety of asset classes. Those are stocks that have similar characteristics. Like I just mentioned, U.S. small company value firms, U.S. small company growth firms, etc. Always have them exposed. We don't know what period of time small value will go great, or U.S. large companies. We don't know any of that. No one does. I don't care what Jim Cramer says. He doesn't even know. So always be exposed to those. And here's the third part.
What?
And the toughest part.
What? Wait, hold on. You mean Jim Cramer doesn't know?
I'm going to check, but I'm pretty sure his track record suggests that he does not know.
Oh, Jimmy.
Here's part
Say
3.
It ain't so.
Sorry. Ignore recent performance. Don't get caught up by recency bias. Here's what's happened lately. It will continue to happen, because we know that it basically is a fallacy that here's what's happened the last 3 days, it'll happen the fourth. It gets so many people in trouble, whether it's individual stocks, whether it's sectors, whether it's stocks versus bonds, any parts of the market, Don, we have seen recency bias cause people huge heartaches. No, you got an asset allocation, a stock to bond ratio. That's what it is. It's for you, not designed to whatever happening in the world at the time.
Well, that is just terrific information, Tom. And I have some even better information. Speaking of Bitcoin, what if you had put $10,000 in Bitcoin a year ago?
Oh, you're going to make me feel really bad now, right? Oh, gosh. All right, go ahead.
Ready?
Yeah.
Are you sure? I don't know that you can take this. $10,000 1 year ago today would be worth $83,000.
Now, here's something to pay attention to. Risk-adjusted return. How much risk did you take to make the $70,000? When can you get your money back? Can you go to your bank? Although you can't go to banks anyway and get any help. But can you go to your bank and get them to return the no, you can't. It's complicated. And Bitcoin is not something, and Don has got his tongue planted firmly in the side of his cheek, recommending that you buy.
No,
so
Tesla, $10,000 a year ago?
Yeah. How much?
$60,000 today.
Yeah. Okay.
But again, here's the thing. Tesla, this is one relatively small in the grand scheme of automobiles companies. It really is. And for it to be worth that, by the way, Kathy Woods from ARK, the ARK innovation fund.
3,000 a share, right?
Yeah.
3,000 a
Well,
share?
you multiply that out, and she's estimating that Tesla in just a few years will be worth $3 trillion.
That's with a T?
Yeah, that's with a T.
Wow. That's.
Yeah.
I hope she's right, because that'll mean good things for the world's economy. But at the same time, that seems a bit of an outrageous prediction.
These values are ridiculous. And Bitcoin, as we have seen, can go from incredibly high to incredibly low in the blink of an eye, and you won't catch it. You don't want to play. This is all gambling. Do you know that I have heard that people turned a single dollar, I've read about this, into $250 million in 1 week. Do you know how they did that?
They went to Las Vegas and
Lottery
won a
tickets.
particular.
Lottery tickets.
There you go. Okay,
Lottery
$1 to
tickets.
All right.
I mean,
good.
that's a return on your investment.
certainly is.
855-935-TALK. You can call that number and ask us questions. You can also leave your questions at talkingrealmoney.com on the contact form. But today we have a question on the phone. You want one?
Good.
Yeah, you want
Please.
one. You love questions.
I do.
Pay attention today.
Okay.
Hi, my name's Paul, and should I treat my pension as a bond fund like I have been doing with investing 100 in mutual funds, stocks only? That's my main question. I also have another question. Why you guys frown upon mid-cap funds, and I think that's pretty much it. Right now I'm at a 90% large cap blend and an 8% small cap. 10, almost 10%. All right. Thank you.
You know, this question comes up a lot. I have a pension. I have X amount. I've got fixed income, basically, is what they're saying. I have a fixed income portfolio. I'm getting X amount a month. Isn't that just like owning some bonds for income?
Well, and the answer is, how did you feel a year ago? I mean, if it was okay that the stock part of your portfolio was down 35%, didn't bother you, then sure, right? I mean, because really, at the end of the day, if you want to make the most money, Ken Fisher is right. All stocks does make sense. The reality is most people cannot take the pain when it comes. And remember, don't ever forget how you felt a year ago, because we're poo-pooing this. We're being silly. But people were panicked.
Silly.
People were sure that the world was not going to ever be the same.
Silly.
Ever.
Silly.
And okay, it's
Speak for yourself,
supercilious.
silly boy.
I mean, it's so don't just push that aside. The reality is, if you can take that, then sure. Otherwise, no, you need to have more fixed income to cushion the blow when stocks decline.
And here's the thing. You're conflating different things. It's like saying Social Security is a bond. It's really not. Social Security is an income stream. A pension is an income stream in retirement. A bond is not meant. See, this is where we get confused. So many people think about bonds and their yield. We don't think about bonds that way. We don't think about them as an income stream. We really don't. We think about bonds as a stability resource, a means by which to lower the amount of volatility over the entirety of your portfolio if you can train yourself to look at your portfolio as one beast. Bonds exist to reduce the scare factor.
I think that's a very good way to put it. And here's the other way to look at it. Are you okay seeing your portfolio go down by half?
Because that is
And if you've
actually
taken the
what
risk
it
quiz.
has done.
It has done. And if you've taken the risk quiz, it's free. Go take it. That'll give you a score. If your score is like 60, I'm going to tell you, no, you shouldn't be in a portfolio that's 90% in stocks. And by the way, back to mid caps. I got nothing against mid caps. I got nothing against.
There's just no evidence they do anything special for you.
Well,
you own mid caps in a diversified portfolio. You do.
The action has been greater on the outsides. That's why we advocate actually over investing your money to smaller companies, owning more smaller than they make up in the marketplace. It's a little bit hard to understand sometimes, but it has actually resulted in higher returns over time.
And there's a gradual difference, certainly, between the expected returns from high-quality large-cap companies and mid-cap, but the difference there is tiny. The difference between large cap and small cap is substantive. It is very large, and it is worth overweighting based on those historical tendencies, which tell us nothing about the future.
Yeah, you're not guaranteeing your 127% return in the last year into the future in small value.
Thank you very much for your question, and everyone else, do the same thing. Call us at 855-935-TALK. Write in a question at talkingrealmoney.com on the contact form, or actually push the little microphone button on the contact form and record your question there. It'll get right to us. We'll put it on the podcast. Thank you.
And don't forget to ask for our help. We've had a lot of people in the last. Well, we've had a lot of people in the last few weeks who have written us and said, "Hey, do I own all these various asset classes? Will you look at my portfolio?" Yes, we will take an hour of our time. We'll look at your portfolio to make sure you're properly allocated. And here's the answer: most of you aren't. You think you are because I've been doing it this way for 10 years. I made a lot of money. That's always people. I've made a lot of money.
Yeah.
I'm happy for you. I don't know what that means. It's meaningless.
It means that everybody who was invested in stocks over the last 10 years made a lot of money.
Yeah, exactly. So that's not a great statement. But the bottom line is, if you want that kind of help, how do they get it, Don? Tell them how they get it, Don.
Yeah, they just go to Vestry.com, scroll down, set up an appointment. And here's the best part. You hear people say that, and we'll give you a free consultation. No. This is actually a meeting in which you will walk away going, oh, wait, I learned something. And there's no obligation. We don't want to sell people on becoming clients of ours. We don't need to sell people on becoming clients of ours.
No, we don't.
People just they're looking for somebody who's going to tell them the truth. Isn't that a nice concept? And who they can trust. And they know, and most of you know, if you've been listening to us for any time at all, we've both been around for a long time.
Oh, please, let's not go there.
Long time.
Yeah, that hurts.
So, I mean, you might have been listening to me talk about money in some call every once in a while. Yeah, Don, I'm really close to the end here, but I've been listening to you since you were like a 50-year-old back in 1902. No, since 1988.
Mr. McDonald's only been on the radio since 1888. Let's keep that straight, not mess it up anymore. He and Mr. Marconi, very close friends.
Yeah,
at the
but
Italian
back then,
school
you want to hear my voice back then?
Yeah.
In the 1880s.
Go ahead. Yeah. Sounds good.
That's how I sounded. But it got deeper.
The train's going.
It got deeper with time. It just got way down here. A lot more resonant. All right. Thanks for being there. I'm Don. That's Tom. We sit around talking money. Real money.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?